Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over Twitter, look at some information on Twitter. I'll give you my financial opinions on it. Some people value this because maybe I have a differing opinion that they want to hear given the information that's posted. But we'll walk through it together. We'll take a look at it and I'll give you opinions on it. So again, if you want to follow me on Twitter, you can follow me at finding_finance if you want to add me. So I'm reposting a lot or retweeting a lot of this stuff. We'll go over some tweets that I've had. So it says the exponential increase in the U.S. public debt is setting the stage for a massive collapse. Collapse in debt will also trigger the subsequent collapse in asset values, most stocks, bonds, and real estate. This is why it is wise to own gold and silver. And what he's talking about is the exponential line as the debt increases. It's a function of the design of the system. It has to continually grow for it to exist. A lot of these do not collapse in a deflationary type move. They usually collapse in a hyperinflation where people have problems with repaying the debt. It could be physical limitations in the system. It could be oil. It could be GDP growth. It could be some problem. And they usually print, give money away so that the system can survive. Some people say that they're doing it on purpose and that they want a new digital currency or some other currency. I'm not exactly sure if that's why they're doing it. I think they're trying to hold it together, perhaps. But either way, we are going vertical in our debt. Coming down here, it says, no way will producers add volumes in this type of environment. It's all about dividends, buybacks, and debt repayments. Supply situation will get even tighter. What happens if recession risks aren't as bad as believed? So what is going on? What he's talking about is crude oil. And producers of crude oil are not going to add volumes at a low price and with the volatility where it's at. So what they are going to do is not add volume, but actually repurchase their shares because they're going to think that their company is undervalued. And they are unbelievably undervalued. The problem is, in this type of environment where we've got the number of days on which Brent price moved by more than $5 a barrel, it's very volatile. What's happening here is the inventories are still getting drawn down. We are still seeing strong, robust demand versus supply. And if what people are projecting in the markets does not transpire, what happens if the recession isn't as bad as believed? Or what if the oil demand doesn't get killed like some people believe? You are going to be left with a gigantic hole in the markets. It's going to be a big deficit. And what you're going to do is they're going to stop releasing the strategic petroleum reserves. We have not put the money back into investing for increasing volume flow. And you're going to be left with a gigantic problem. So the SPR release is actually causing or could cause a bigger problem. So that's his opinion. I agree with that. I think it's all kind of stupid. Here's a cool chart I really like by Grady. It says, back April 2020, when I called the commodities bear market low, I said that low would reshape the investment world. We are seeing that slowly happening. This chart with TSX, what TSX is the Canadian Exchange Composite Index. And what we're seeing is the Canadian Stock Exchange actually break out to the upside here. It's mainly commodity companies in the TSX, and that's breaking out against the S&P 500. All of these things are overlapping together to create a picture, to describe something that is occurring in the markets and is happening and changing. We're seeing commodities really start to outperform everything. And this is where I get excited because the most amount of money is made when you identify these things very early in their cycle. That's when you make all the money. And these are very early in their cycles. They're all starting to break against each other. And it will be incredibly volatile because when these things start to turn and break, they usually occur when the S&P 500 is rolling over. So the S&P, people get afraid. They can panic. You'll get large sell-offs. It's very volatile. And we go through a very volatile period. And I'm not saying just the TSX. I'm saying everything becomes volatile. You'll see decoupling, coupling. You'll see leveraging, deleveraging. It's all kind of this huge kind of chaos in the market, and people get very afraid. That is what the transition between paradigms looks like for a little while. It could be a year or 2 or 3, unfortunately. But right now, the TSX looks like it's going to in a killer spot to move on up. Here's John Kemp. It says, U.S. Shale Revolution, 2010 to 2019 and its aftermath, 2020, 2022. U.S. production accounted for more than 80% of the increase in global output between 2010 and 2019. I've even heard that the output growth almost entirely happened in the United States. Here's the problem with that in the medium term. That growth all came from the United States, and I don't think that the United States, the shale oil, can grow much more so than what it already has. I think it's actually going to decline at some point. That decline is going to be drastically felt on a worldwide basis because the rest of the world isn't increasing supply. It's actually decreasing. And I don't know how much more supply the rest of the world can actually increase, because each year you have to offset the declines in oil production. And those declines not only have to be offset, but they have to grow above and beyond it to grow your production of oil. And I don't know if we have that much in the pipeline to actually grow production of oil. So as China comes out of lockdown, as the world recovers, and it will recover, we will be constrained by how much oil is out there. So that is really what my focus is on, is this demand supply pictures coming up over the next few years and positioning for those big moves. And I know people want to try to time everything. They say, oh, the stock market's going to go down, and it very well could. And I probably agree in the very short term, we're going to see selling pressure. I've already built my positions. They are riding all over the place. And I have some cash that I've built up over the past half month or more, and I'm going to deploy it on pullbacks. That's my strategy. And I'm not going to try to time the short term. Not going to do it. It says major market bottoms have occurred in October more than any other month. So this is the major S&P 500 lows since 1932 by calendar month. October is the major market bottom. That's probably what's going to happen in our scenario. October timeframe. It's coming right on up to it. Now, here's something else that's pretty sweet. Halftime update. Low supply is indeed causing prices to stabilize or even rise in the face of all adversity. And what this is this is the housing market update. Rising prices amid falling demand and supply reflect a new weird. And what's weird is we're actually turning up in September 18, according to Redfin. So when I was talking about this, we knew that there was seasonality in these numbers, and we should be looking at everything from a year-over-year basis. The increasing interest rates and that dynamic is difficult to really put a good read on because of all of the things that were happening so quickly. So I said, well, what if we get an overdramatic pullback in the seasonality, but it actually comes back? Almost as if people were afraid and they all kind of dumped homes all at the same time, which was a high possibility. And I think that's kind of what happened. When I look around my area, I could see that a lot of people dumped homes all at the same time. And now we've got hardly any homes coming on in relationship to what it was a couple of months ago. So I think that it mirrors very similar to what this is, and prices are actually rebounding higher. As weird as that sounds, it almost sounds like jumping too early on the crash bandwagon isn't what you should be doing. You should be waiting for the data to play out. Just relax, get these numbers in, and see what the markets do. We also had a rebound in housing starts upward by another 100,000 plus or so. So we are seeing the market bounce here. Will it be sustaining? I don't know. We'll have to wait and see. Demand and supply are dictating these numbers. and there's very low supply, and obviously the demand could get cut quite back too with the interest rates and the affordability. I understand that. Let's just watch what the data tells us. It says banking crisis will start in Europe. Martin Armstrong, could Europe suck the rest of the world down the tubes? Armstrong says, oh, absolutely. Europe is the problem. The crisis in banking will start in Europe. The debt is collapsing. And the debt is collapsing. I think that's why we're seeing interest rates rocket higher. People are leaving the bond market across the board. We are seeing bond market problems not only in the United States and Europe, it's everywhere. And bonds are actually falling. So I'm ahead of it. I look at things a little bit different, and I'm getting my positioning before that. It says many foresee the Fed hiking to 4.5 to 4.75% in mid-2023, followed by rate cuts to save the day. No two cycles are the same, but just want to remind you of this chart. So stay defensive. That means the speculative junk of 2021 remains a no-no. Growth stocks out, value stocks in. So this is the S&P 500. You can see Greenspan's first rate cut. Here's Bernanke's first rate cut before a lower move in the S&P 500. Remember, I'm not playing the S&P 500 though. I'm in stocks where, or I should say commodities, that move on higher when stocks get rotated out of. Value stocks are what's in, and that's what I'm in. That's what the thesis of the channel is in. It says commodities do not cause inflation, money printing does. Well, by definition, I would agree by that. But the way that they measure it, commodities can cause consumer price index inflation, the CPI number. So commodities impact the CPI. Inflation, by the old definition, he is right that money printing is what actually does that. The problem that they have their self in is that they have a shortage of commodities at the same time that they're running into debt problems and they have to create money. That's the problem that they're in. They have to create money, which causes inflation, but at the same time, we're choked by the commodities. Here's one. I agree with Toyota. Until EV manufacturers have secured enough supply of battery raw materials to truly ramp production, a shift by developed markets to hybrids could ease raw material supply pressure and set the energy transition on a glide path to achievability. I don't think the future based off of the mineral intensity is in electric vehicles. It's actually in hybrids. And Toyota is actually on top of this, I think. They're probably the most forward-looking company that I know in the markets, definitely in the vehicle markets. The electric vehicles are far too mineral intensive. You're going to run into constraints of mineral supply, and EVs are the ones that are going to have the biggest impact. I should say hybrid vehicles are the ones that are going to have the biggest impact. And you don't need charging stations and more transmission lines built. You can use the existing infrastructure and become a lot more efficient with the use of the fuel. It says, no, not bullish gold all the time. We sell the major highs at the service. Last time, April 2022. Yes, very bullish. The commodities bulls since called start in April. No bull is not over. This secular bull will last 10 plus years. CRB 200% plus. Baby bull move was the beginnings. That's basically what we're at. I agree with that. OPEC spare capacity has collapsed. This was large capacity back in 2020, and this is just collapsing down. And we're maybe at 1 million plus barrels of spare capacity at this time. When we look forward, the spare capacity is probably going to get eaten up completely. I don't know what that means. We're going to eat through inventories at that point. Inventories hit a certain critical spot. Then we're going to have to use the price of oil to basically collapse the demand. Coming on down, we've got 37% of registered platinum inventories gone today as 44,000 ounces leave the category. We're at the bottom of the barrel in sight now. Here's another one. It says the housing shortage in the U.S., once seen as a coastal issue, has increasingly become a national problem. It's like the cancer was limited to certain parts of our economic body, one economist said, and now it's spreading. The housing shortage isn't just a coastal crisis anymore. And that's, again, the supply demand and how low we are in inventory. We're eating through our inventories. And even though we've got increasing interest rates, and I think they're probably doing that on purpose because it's more or less a reflection of how tight we are in the housing market. This is Camco chart pattern last bull market. I posted this in June. I said, the pullback bear trap that occurred last bull market might occur this bull market. Time will tell. The fractal today is much larger in size. And what happened last, this is our current bull market. If you look at the last one, what happened was we came up in that cylinder, spilled out in a bear trap, and then took off and ran higher. We very well could do this this September, October timeframe. We could drop out of this and scare everyone out, get a great buying opportunity, and head higher. That is a possibility. This is what it looks like right now. That was in June. I know we bounced higher again, but we very well could fall back to the downside in a bear trap type scenario, move on down, and then rip it from that bear trap. We've got copper to gold ratio. One thing that is a little bit worrying is that we do have a bear flag pattern that we could head lower in. That could indicate that we've got economic problems ahead of us and we could head lower if this breaks to the downside, which it very well could. This is definitely a bear flag. So we could see lower prices in the copper to gold ratio. Now, the weird thing is the copper to gold ratio is usually tied to interest rates, and interest rates have been heading higher. We've seen a very good correlation there, and I'll show you what that looks like here. There's your correlation between copper to gold ratio and the 10-year government bond yields, and this has massively diverged. Either interest rates will go down, or the copper to gold ratio may go up, or we live with a large disparity between the two. But right now, they're going in opposite directions, which makes it very difficult to put good forecasts in of what this market is actually going to do. Because usually bonds in a deflationary type movement, I'm talking deflation here, go down. And right now we're seeing everything go up in terms of yields. So that's a big divergence there. We'll skip that one. The silver still looks to outperform gold. We had an increasing ratio of gold outperforming silver. We hit a capitulation bottom and broke that uptrend line. We usually see a retest of that breakout, and now we're doing that retest. Silver actually looks very good from a ratio perspective against gold. Here's the big picture. Still looks solid to me. Commodity to S&P 500. We're still rocketing higher for commodity outperformance. I don't see anything that is that bad. I would still rather be invested in commodities than the overall stock market. They are outperforming. And even though we might see some volatility in the short term, I'm remaining long in my commodity investments. I also put in Peter Lynch, the famous speech there. It says, I thought it was obvious to most people. Again, the massive increase in debt is offsetting the falling energy return on investment of oil. When the Fed and central banks can no longer increase debt to offset the falling EROI. And that's what's happening is your EROIs are falling and the debt is increasing. And we don't have that corresponding energy surplus to produce goods and products and services. And we've got a large disparity between that. That could result in either a collapse of the debt through inflation or deflation, depending on how it collapses. Here's another one. It says, the bottom 4 shale oil fields display troubling signs. Market totally unprepared for collapse of U.S. shale oil production. That production is where the majority of our growth has come from U.S. shale. If that were to collapse, we are going to see collapsing oil around the world. So I think oil is one spot that's going to be a great look for potential investment. But I'll end it there, guys. That's what I've got for a lot of the information on Twitter. I think it's got good information on it. And, I'm remaining long in my investments. I know a lot of people are like, well, there's going to be a collapse. You got to sell out. Guys, it's going to be short term. It's going to be short lived. It could be brutal. I understand that. My strategy is ride through it, buy the lows when it happens. So that's my strategy. Obviously, people can disagree with it, but that's what I'm going to do. And right now, all of the physical markets are draining their inventories of all of these commodities. That looks pretty bullish to me. So I'm not going to try to time this. I'm just going to ride through it. Anyway, guys, that's what I've got for today. If you guys like the content, give me a thumbs up. Subscribe to the channel. Subscribe to the website if you guys need help in this bull market. Finding-value.com, the platinum membership's the membership I would choose. And we'll catch you next time. This is Finding Value.